Have you ever wondered why everyone seems to be going to Japan lately? Or why furnishing my entire house with custom furniture from China seems to be more affordable than buying from IKEA? Typically, when a manufacturing country like China and Japan have a trade surplus, the effects cause the currency to rise and cause things to get more expensive. When more money flows in than out, demand for the currency increases and the price should go up. But if you've traveled to Tokyo recently, you know the feeling. The restaurants, hotels, cafes, everything feels cheap. People seem to be spending money faster than ever. But this is by design. A weak currency makes exporting cheaper. It keeps factories running and it makes the tourists feel like spending money, especially when you see all those tax-free signs and discounts everywhere. But when you look at China, they just hit $1 trillion in trade surplus. That means China sells more than the next 8 countries combined. And yet, the renminbi refuses to rise. Not because it can't, because China is keeping that way, because they fear something far worse than slowing exports. For 20 years, the Chinese citizens all knew how to get rich. You buy a property in any city, and then you watch your wealth grow. Your savings went into your apartment, your kid's future went into your second apartment. And then Beijing burst the property bubble. It was not by accident. It was all by design. Developers started failing. Construction stopped. We lost so many projects that year, and friends were just happy to even have a job. For Chinese families, they didn't just lose money, they lost their sense of security. At the core of the Chinese society, there's an unspoken bond between the citizen and the government. As long as there's peace and prosperity, the government can continue. But Beijing saw what happened in the US in 2008, and they knew that things would be far worse in China. So they held the currency steady by printing more money. Not to manipulate the market, but to keep things in place. Because when people lose hope, that's when the country becomes unstable. So here's the part that most people will never see. For almost 2 decades, China's surplus never stayed inside China. The money left through a great escape pipe. Chinese companies invested abroad, buying US assets, holding US bonds. China earned this surplus by selling products to the rest of the world in US dollar, and the American stock market captured all of this money. And many of us global investors benefited from this. But in 2021, the system cracked. The party was over. Foreign investors started pulling their money out of China. The term uninvestable started showing up everywhere. Chinese companies slowed their offshore investing. They stopped buying US bonds. This natural escape was closing. And for the first time in decades, this surplus started staying at home. And something remarkable happened. Chinese banks exploded with deposits. In 2024 alone, household savings rose by nearly 20 trillion yuan. That's a generation's worth of capital just sitting there, waiting. Because during COVID, people got scared. When the housing market fell almost 30%, suddenly people were feeling poorer. When you walked through the city, shops were closing, restaurants were quiet, and almost every business owner I spoke to that year told me, business is bad, times are tough. When people lose hope, that's when things get risky. At this point, China had 2 options. It could either pump up the property market again and try to make everyone feel rich, but that would only push the problem into the future and make the crash worse. So the other choice was to slowly guide the country towards a new way of saving and building wealth. And that's what Beijing started to do, very quietly. They told state-owned companies to raise dividends, meaning that they should pay people more money for owning their shares. They even told some of their companies to start borrowing money just to buy back stock, to make stock investors feel richer. The message was clear. We want people to start investing in stocks, not just in property. This isn't some short-term boost. It's not some quick rally. It's the beginning of a new financial system, one that can hold the country's savings for the next decade. China's biggest obstacle isn't economic. It's actually psychological. For decades, retail investors have been treating the stock market like a casino. It's just part of the culture to gamble. chasing momentum, buying on rumors, panicking at the dips, hoping to be making quick money. Beijing isn't trying to create a new stock market boom. They're trying to create a floor. A slow and predictable climb with low volatility, higher dividends, and state-owned companies that behave like steady utility companies rather than speculative gambles. This isn't just a slow bull market. It's a cultural reset, an engineering shift away from this gambling mindset into a long-term saving and investing mindset. Now, experts are debating how the next few years will unfold, because this one decision, what China does with the currency, shapes everything that will come next. And this is why investors like us need to pay attention. Option 1. The currency is allowed to strengthen. If China allows its currency to rise in value, a few things will happen immediately. Dividend-paying state companies suddenly look more attractive. Imports get cheaper, households feel a little richer, and those who can afford to travel abroad will also feel this wealth effect. But Chinese factories will lose some of its competitive edge if the currency gets too expensive. Option B. They control the currency and they don't let it rise. The other option is to hold the currency down. If they do that, the central bank has to print more money to absorb all the dollars flowing in, and all the extra money has to go somewhere. And if it can't go back into property, it moves into tech. Alibaba, Tencent, AI companies, and semiconductors, the kinds of companies that led the US boom from 2010 to today. This creates a completely different kind of market. So yes, in theory, the RMB should have gone up, but it's not. And the reason isn't about markets at all. China is wrestling with something much harder. With everything that's going on the world stage, with the trade war with the US, they're trying to keep things at home stable. And when Beijing is trying to build a new kind of future, a steadier system that they can hold the country's savings without depending on a property bubble, it won't look dramatic from outside. But if you watch closely, you can see these things taking shape. China is trying to make everyone an investor, through pensions, insurance, and dividends. Well, that's how I see it from where I'm standing. Let me know what you see from your side.